Alright, hello. Um, we'll be starting in a few moments. Yep. Good evening. Yep. Hello. Good evening, everyone. Hello. This is my voice. Could be because of the microphone. Can everyone hear me? Fine. Alright. We can begin. So, hi. This is I'm Gavin. So I run sgstockmarketinvestor, and thank you guys for joining this Q&A session. Uh, I collated quite a few questions over the past week, and I've basically summarized them onto uh, a few key ones that will summarize all the questions asked. So, without any delay, let's get into it. So, the first question I got, which was very popular, was what is the criteria for picking growth companies? So, there is definitely a lot of ways you can pick growth companies. There is you can use screeners, you can uh, go on Wall Street bets. There's a lot of ways you can find, but how do you actually screen them to find out which is the best one that you should invest in? So this is not all, but this is some of the criteria that I look for when picking high growth companies. So the first one is pretty straightforward, which is a company with a strong moat or disruptive factor. So meaning a strong moat, which is a competitive advantage over its competitors in the same market, right? And or perhaps a disruptive factor, so something that it's doing differently as compared to its uh, competitors as well. And then the second one is actually very important as well, which is a fantastic management team. Just because you have a fantastic product or a company is not enough to bring you all the way up. You will need a fantastic management team to actually bring the company to greater heights. And then, of course, huge long-term growth potential, because I myself am a long-term investor, right, with a very long investment horizon of at least 10 years and further out. So I want to invest in companies that will be here in the next 10 to 20 years, and they're going to be 10 times bigger, 20 times bigger. And the last one is for high growth companies. these companies have to forego profits to keep on growing exponentially. So what do I mean by this? Most high growth tech companies are actually able to be profitable but choose not to. So what I mean by that, when you look at their financial statements, you actually see that they spend a lot on research and development and sales and marketing, and you realize that if they took out a big portion of that expense in to help grow the company, they'll actually be profitable. Which is why sometimes companies like to report non-GAAP earnings, which is another way to show how the company is actually doing as compared to just looking at the income statement on face value, right? So what company fits this? So here's a very good one that I talk about a lot: Lemonade. So Lemonade is a tech company, right, that works in insurance. And so let's get into why Lemonade fits the bill. So for the first factor, strong mode or disruptive factor. So Lemonade is disrupting the insurance industry with tech, right? They're injecting AI and technology to help speed up the process and basically improve the entire customer experience when you get into insurance, right? So typically when you buy insurance and then let's say you want to make a claim, you need to go find your insurance agent, you need to send pictures, and then they need to write a report, and then it takes forever to get your claim actually done, right? So with Lemonade, they've actually took out the middle part and then it injected it with AI and tech, right? So they have a chatbot that you can talk to, and you can make claims through the chatbot. Now, of course, Lemonade is still new. It's about 4 or 5 years old, and as with AI and technology, these technologies actually grow to be a lot smarter as time passes because you have a bigger data set to work with and it's easier to train the AI. So Lemonade uses this to speed up the process of claims for customers, which is why they have so many happy customers, and you can find it on their website as well. Yep. And moving forward, next one is fantastic management. Of course, their CEO is really motivated. You can listen to his interviews on CNBC. Uh, he really knows his stuff, and he has a very straightforward plan as to what he's gonna do with Lemonade. He's not feeling out or testing out the waters, but rather he knows what he wants to do, and I assume he has a plan for that as well, right? Third would be huge long-term growth potential. So for Lemonade, when they first came out, they only offered homeowners, renters, and pet insurance. Now, these three insurance policies are not saying the highest earners, right? And just last quarter, they moved into term life, which is one of the higher earners of insurance policies. So, Lemonade has a huge growth potential over the next 10 to 20 years, based on the fact that there are so many other policies that they haven't gotten into, like auto, and so on and so forth, right? And they also have not expanded out geographically. So they are currently in the US and they've recently went into Europe and specifically France. So there's a huge geographical growth potential for them to expand out into other regions. And that could really exponentially grow its company size. And for growing profits to grow exponentially, if you look through the income statement, you can see that the sales and marketing and the research and development is growing very fast. They are pumping in so much cash to start growing the company a lot faster. So Lemon is definitely one of them, and I have a few other criterias as well, but this is just a rough idea of how I pick high growth companies. Moving to the second question, which is also another very popular question: what is the future direction of the market, right? So over the past 2 weeks, we've seen the market take a very steep correction uh, of about 10-15%. Some stocks even fell 30% from all-time highs. So the market's very volatile right now, and everyone's wondering what's gonna happen. Is there gonna be another crash? Is there should we sell and hold cash? What should we do, right? So here is a graph of the S&P 500 over the past X amount of years since it first came out. So if you can see the general trend, it's going up, right? Okay, there's like minor corrections here and there. It's moving up slowly. There's always pullbacks and crashes, as you can see, but the general trend is up, right? Because the economy moves up, because of inflation, because of a lot of other factors as well. So the overall trend is definitely going to be up. The market's going to go up over the next 10 years, the next 5 years, 10 years, 20 years, right? I as a long-term investor don't really touch too much on short-term volatility because it's too much you, it takes too much effort to actually figure out what's going to happen in the short term, and you have so much room to make mistakes, right? What if you sold at the absolute bottom and then the stock rebounded and went up, or you bought at absolute high and then it crashed all the way down? So for me, I would rather just have a long-term investment horizon, and that will actually help you out with your investments by a lot. So third question, thoughts on options. So I personally have not touched into options yet, but of course I'm looking into it and learning about it as we go. Um, for options, right, I believe it's a fantastic tool to grow your wealth at a very fast pace. It is leverage, so of course it works as a double-edged sword, right? You could get burnt really bad, you could become a millionaire overnight. But with options, I would personally recommend understanding as well as learning and picking up a few option strategies. Be it there's a lot of popular ones like selling puts and whatnot, but those are what I would call basic strategies. There are slightly more advanced ones like leaps, which are long-term equity anticipation options basically. There are also there's also the wheel strategy, right? Which is for you to sell the put and then collect the premium. But if you get allocated the shares, you sell calls and then you repeat the wheel. Um, there's also bull put spreads, right? There's 1,000 different strategies you can learn options. The important point is to actually go and learn a few. You don't have to know all. You don't have to learn all. You just need to know a few. And then just keep honing onto that. Keep improving on getting better with the strategy. And for myself, I personally like the wheel strategy because it works for the short term and the long term, right? But of course, the stock that I choose will be long term plays that I don't mind holding for a long term, right? So companies like Lemonade or Palantir, I wouldn't mind applying the wheel option on wheel strategy on these stocks because I know that the risk of the strategy is that you might end up with the actual stock, right? So for myself, because I want to hold these stocks long term and I want to accumulate them along the way, I don't mind actually ending up, being allotted these shares. Question 4. How to identify strong dividend payers consistently? Now, there are a lot of gurus on the market. I'm not going to say who, I'm not going to say what, but there are tons of content on the internet that talks about how do you find dividend payers, passive income through dividend stocks. But a lot of them don't really talk about what's the most important thing when finding these, companies, right? So this is what I actually use. This is not the full list, right? Because this is just a rough idea of how I look for strong dividend payers. And my criteria list is pretty conservative. So of course I might miss out on certain opportunities as well, right? So you have to weigh out the rewards here based on how much risk you're taking. So just to briefly run through my criteria for picking strong dividend payers, the first one is very conservative with their payout ratio under 80%, meaning for every dollar they make, they're gonna pay out less than 80 cents as dividends. The key reason is actually very simple. We don't want to invest in a company that burns cash, right? There's several companies that kept on paying dividends way more than they were earning. They were making $1, they were paying $2 of dividends, and they're taking on debt or they're burning off cash just to keep on making shareholders happy. And when picking strong dividend payers, we want companies that are able to pay consistent and possibly increasing dividends over the long term. right? So having a conservative payout ratio sort of helps you scope down into companies that are more conservative. So second point would be consistent dividend history, right? You look through the history. It's not that hard to find. You could Google it. You can go look through their annual report. Look for companies that have been consistently paying good dividends over the past 5 to 10 years, right? 5 years in Singapore, there are not a lot of companies that have been paying good dividends for over 10 years. There's only a small handful like OCBC, um, Viacom, etc. So uh, you might miss out a lot of opportunities if you look at companies that can pay out dividends over the past 10 years. So an easier way would be to scope it down to just 5 years. So what you want to look for is dividends that are at least maintaining or increasing would be the best, right? But don't be afraid if the dividend does drop, because there are times where the company might face something bad and they couldn't pay out a dividend for that certain 1 year, like a one-off loss or expense. So if you see some random trends, like the dividend suddenly dropped for a year and then went back up, look into the results for that year, check what happened, right? The third point is low debt or current ratio more than one. So current ratio is basically when you take the current assets divided by current liabilities. If it's more than one, that means your liquid assets are able to pay off any short-term liabilities that you have, right? So like loans, debts, trade payables, etc. So the rule of thumb is to always have a current ratio more than one. That means the company has sufficient liquidity to pay off any short-term debt, right? And then obviously the best case scenario would be to have your current assets actually be higher than your total liabilities, which means your liquid assets can pay off all your debt, short term and long term, which means uh, the company is very safe. The balance sheet is very solid, right? And then the fourth one, it's a pretty boring criteria, which is predictable business. So, what is a predictable business? Let's take Sheng Siong as an example. What does Sheng Siong do, right? Sheng Siong is a supermarket. They sell food, they sell drinks, they sell consumer stuff. It's very predictable. You know what they do, and you can roughly gauge, oh, this year they're gonna make this much, next year they're gonna improve by a bit and a bit. It's very predictable. It's not gonna go up by 100% and then drop down to 100% next few years. You're gonna have a rough feeling of what's the trend gonna be like, right? Another example is Viacom, right? Viacom's business is so predictable. They just do vehicle inspections in Singapore, right? That the business model is simple to understand and it's recurring in a sense, because by law vehicles have to be inspected every year, every half year, every 3 years, depending on what vehicle and how old it is, right? And then last but not least, this is an additional one, but it's not necessary, which is a company with a strong moat. So companies with a strong moat have a lower chance of being disrupted in their industry, so you won't have a high chance of a new player coming in and just disrupting all their businesses. So let me give you an example of a company that fits this bill. Singapore Exchange. This is a relatively interesting company which everyone knows of. It's basically the exchange that we trade on for Singapore stocks. So let's take a look at Singapore Exchange. Payout ratio. As per the latest one, which was 32 cents, they pay out under 80%. And if you look out at their dividend history, they've been consistently increasing it every year, and that's amazing, right? Low debt, checked out, everything looks good. The business is predictable, right? The business is basically they run the exchange, they charge a fee, so on and so forth. And then they charge a fee for IPOs, they charge a fee for buying and selling stocks on the market, etc. And then they have a strong moat. Singapore's exchange moat is so huge because of the fact that there's no other competitor here. There's only one exchange. There's only one CDP. No one's gonna replace CDP, right? So it has a huge competitive advantage, and no one can actually come in here and say steal some market share, because it would be too hard. The barrier of entry would be way too high. So moving forward, uh, another question I get quite often is what are some tips for beginners, right? Because With the whole stock market being so cheap right now, with the recent crash, there are a lot of new investors coming to the market trying to make a fortune, from all the hype news that's been going around. So there are tons of beginners, and I myself was a beginner as well. And I started out with no help, no mentors, didn't go for any courses. I just went on YouTube, watched a ton of Warren Buffett interviews and AGMs, and just understood how to invest from there. So I'm gonna share some tips for newer investors. So what market should you start with? Now, Singapore investors have the luxury of investing in our own market as well as other markets through brokers that are not charging obscene fees, right? Because you have Tiger Brokers, you have Interactive Brokers, you have TD Ameritrade, you have a lot of new brokers. So it gives you the flexibility of investing overseas without paying huge fees, right? So for investors starting off, here are the two key markets that investors in Singapore actually invest in, which is Singapore and US. There's also the Hong Kong and Malaysia market, but Singapore and US are the two primary ones that most investors invest in. So what are the key differences? So first off, the speed. The Singapore market is relatively slow growth. It's pretty consistent. You're gonna see stocks just move 1% up today, down 1% the next day, up 1% again. It's a relatively slow moving market. So as compared to US, which is super high growth, you're gonna see stocks like GameStop jump up 100% today, and then it's gonna drop back down 50 the next day. It's a it's a huge roller coaster, and it comes down to the investor whether are you ready for that level of volatility, and what's your trading strategy, right? Secondly is investing in Singapore. You have the privilege of having no dividend tax, which is huge because that means you're not being taxed on your dividends at all. You don't have to pay any tax. As compared to if you invest in US, let's say you invest in REITs in the US, they pay your dividend. 30% of that goes back, right, to the US. So you only get back 70%. So if you're starting out with a small capital, which most beginners are starting out with low capital, you're not going to see a lot of money coming in, and it's not going to be very meaningful, and it could be demotivating at times, right? So a few other key things to know is local known names, right? So invest in Singapore market, you're gonna see well-known names: DBS, Sheng Siong, Koufu, things that you see and hear every day, right? As compared to US market, there are of course companies that you do know of in the US market like Netflix, Spotify, Disney, Coca-Cola, but there are also lesser known names. So it really comes down to what's your risk appetite, right? And then the last one is relatively small risk, which is currency, right? So if you invested in, let's say, the Malaysia market, the forex would be a risk. It would be a huge risk, right? Because the Singapore to ringgit exchange rate has been going on a downhill. Of course, in favor of the Singapore dollar. So investing in overseas markets could cause in currency risks, but for the US market, I personally don't feel like there's much risk. Yep. Moving on, here are some other common questions that beginners like to ask, which I receive, which is how much starting capital do I need, right? I personally started with $2,000, and that was all I had in my bank. I just threw it all in, and then I just went head first. Right now, because of so many brokers and so many options, you can actually start investing with as little as $100 through robo advisors. Or if you really want to buy stocks, you can buy like with like $50, right? If you buy using brokers like Tiger Brokers, because the fees are so low. So starting capital, a lot of beginners have the misconception that oh you need huge capital, you need $10,000 to start investing, but that's actually not true. You need just as little as $100 to get started. Second question would be what strategy should I use, right? So new investors, tons of them are very curious. What strategy should I use? Should I invest for dividends? Should I invest for huge growth? Should I do value investing? So this comes down to individual, and you need to go and research this, of course, on the pros and cons and whether the strategy suit you. Right. So later on, I'll be sharing about my in the next part. I'm gonna be sharing about my own investing strategy. Yep. And then another question will be: should I start with blue chips? Right. Blue chips are the most stable, supposedly, right? And my answer to that would be don't think of blue chips as investments that I won't lose money on. Blue chips are just large companies, large cap companies in the market. They Investing in blue chips doesn't mean you're gonna make money, but it doesn't mean you're gonna lose money. There's no certainty on that, right? And then you should always do your research, cause blue chips doesn't mean that they're the best, and just cause something is a small cap means it's the worst, right? So it's very subjective. So you need to do a lot of research on that. Where can I find financial reports? So a lot of people get quite confused on where to find all this information. You can actually go to Google and just type, company X results. That it will literally come out because their investor relations page will just come out as the first thing on Google. So you can just search like, oh, DBS results. The first thing will come out, it will be the results. So no need to worry on that. Last part is what broker should I use? So there are a lot of brokers in the market right now. There's depending on what you want. There's local ones like DBS Vickers, Poems, etc. There are also newer ones that came into the market like Interactive Brokers, Futu, or Mumu, right? And then TD Ameritrade, and Tiger Brokers. I personally use Tiger Brokers a lot, especially for my US market, simply for the fact that they charge really low fees, and on top of that, you don't need to pay any custodian fees. And like the withdrawing and deposit process is so simple, and they don't charge you any fees for anything. It's really low fees as compared to a lot of other brokers. So if you're interested, you can definitely open up an account. You can find it in the description below. You can just open up an account first. You can just use the paper account, which is the demo account. You don't have to deposit any money. You can just look around and sort of play with the platform first, right? And they're giving a lot of freebies as well, right? So like with minimum deposit, you're gonna get stock vouchers, free commission trades, etc. All right, next one. What is your investing philosophy or rather strategy, right? So investing strategy. When I started out, because I watched a lot of Warren Buffett videos, interviews, and EGM, so value investing caught on, and not just the typical value investing that you hear nowadays. It's the one that was taught by Benjamin Graham, which is deep value investing, or some might call it cigar butt investing. So that's the old school value investing. So you're looking for companies that are really cheap. You're paying nothing for working capital. Um, they are paying you a decent dividend, really cheap PE ratio, etc. And then as I found out that this strategy is not gonna make me a lot of money because I started with small capital, and it's not a very good long-term strategy because you're gonna have to buy, sell, right? Once it reaches its value, you let it go and you move on. Then I went into dividend growth. So that will be my main strategy. So dividend growth is basically looking for strong dividend payers that not only pay out fantastic dividends every year, but they grow it. So in the US, they have tons of these companies, right? You have dividend aristocrats or dividend kings, right? Companies like Coca-Cola has been paying increasing dividends every year for like the past 50 years or so, right? Companies like AT&T has been paying increasing dividends over 20 years. So in the Singapore market, there's no way you can find companies that pay increasing dividends for over the past 20 years or 100 years. What I've managed to find is companies that grow their dividends over the past 10 years. So here are a few key ones, right? Fraser Centrepoint Trust, OCBC, Vicom, um, SBS Transit actually was previously before COVID, and these are just some, right? So if you look at, you can go to Stocks Cafe or you can just go and Google and go find out that you realize that their dividends are actually growing every year, and that's fantastic, right? If a company is able to keep on growing its dividends year on year for like a very long time span, say 5-10 years, it sort of tells you that the company is doing something right. You can't have a company that's increasing its dividends but something is going wrong over 10 years. That's a huge span. You can't be leveraging and taking on debt to pay because 10 years the bank would start making noise and you'd start paying back, right? And then recently, because my background is tech, I've moved into high growth, and high growth in tech in particular, because that's my background. My education and my experience is all in tech. So it's very easy for me to grasp tech companies that a lot of people don't seem to understand. Companies like Palantir during the IPO, companies like Snowflake, companies like Fastly, CrowdStrike. A lot of investors, I would say a big portion of investors actually went in and invested in these companies, not understanding fully what they did. And of course, this caused the valuation to jump up and down like a roller coaster, which provided me huge opportunities to keep on accumulating. I've been sharing a lot in my premium subscription group as well, so most of the members will know that I talk about the company a lot, right? So in the next part, as you can see, um, TA or FA, technical analysis or fundamental analysis, I can do both. Fine, I can do both well enough, but I prefer fundamental analysis and specifically qualitative analysis as compared to quantitative. So quantitative is just numbers, right? You're crunching out the ratios, P ratio, PS ratio, etc., ROE. With qualitative, you're looking at the company as a business, right? So you're understanding the products, the management, what's the competitors like, how are they better than the competitors, qualitative factors, right? So comes back to when coming back to tech, because I understand a lot of these companies well in terms of their product and such, it allows me to really find value when everyone is in a state of panic, right? Back when Fastly had the whole TikTok drama, when TikTok was taken out of their customer pool, the stock tanked, and I said in my group, guys, let's buy. Uh, I bought, and I told, I shared with the group that, here are the reasons why I bought. And of course, those who joined in would have made some uh, great profits there. But I I I like to share reasons as to why I buy. I don't like to share, buy this, buy that at this price, at that price. I would much rather like to share, this is why I'm buying, and then you can make your own decision. And then last but not least, investment horizon is long term, 10 plus years out. So next question would be, how much cash should you hold and where should you or when should you deploy it, right? So this is the big answer. 5 to 15% of your portfolio by by diversification should be in cash or dry powder. So like short-term liquidity, bonds or treasuries. This is the rule of thumb, right? And you don't have to stick to it very strictly. You could have 0% in cash, you could have 40% in cash. This really comes down to what you as an individual investor want for your risk appetite. If you're looking for a lot of risk or low risk, and whether you think there's gonna be a crash. So when should you deploy? This is a very important thing that a lot of people don't know. So they keep on cash, keep super long, and then they're like, oh, should I buy now? Should I buy now? My idea is that you should buy when it looks attractive, not because of how the market is feeling. So let's say today DBS tanked to $20, right? Your decision should be whether or not at $20 it's fair value, undervalued as compared to whether or not the market thinks it can crash lower or whatnot. I I personally invest most of my investments are based on me thinking that, hey, this is undervalued. I think can go a heck of a lot higher. I don't mind the short term crash if it does come because I know in the long term it's gonna do well. So that's how I approach it. And another common question would be views on the current correction of tech stocks. As I said before, this is a triple Q, which tracks a lot of tech, so you can use it as a good index. Dropped about more than 10% in a short period of time, and a lot of people think a crash could come or whatnot. Just like before, my thoughts and views are not changed. The long term is going to be up. Short term pullbacks and corrections are fantastic opportunities to accumulate more, right? Right. So moving on, how to evaluate a stock. So everyone loves to ask, how do I evaluate a stock? How do I give it a price point? How do I know if a certain stock is worth a certain price? Now there are intrinsic value calculators on the internet. There are tons of them, right? And then a lot of people say, oh, just buy below the intrinsic value and then sell when it's above. But that's very superficial, and I don't feel that that strategy is actually very useful. in my honest opinion. So as I said before, qualitative valuation, qualitative analysis, that's how I like to do things. That's how I invest. So you've definitely seen in the previous point, more disruptive factors. I like to look for this, and then strong balance sheet. I want to see low debt. Then I also want to see long-term growth potentials, be it through acquisitions or business expansion or product expansion, right? And a good track record. So you look through over the past 5 years, has the revenue been increasing? Has the net profit, has the gross profit been increasing? Is everything looking, a good uptrend, solid uptrend, no random volatility? And then the last one is demand for its services and products, right? So this comes down more specifically for tech companies. So companies like let's say Palantir, they offer a huge suite that caters to mainly government agencies. So their TAM, which is total addressable market, is not very huge. There's only so many government agencies, and you're missing out on possibilities like enterprises. So of course, Palantir has expanded a lot, and they've grown a lot since IPO, and they've lowered down the amount of revenue that comes from government agencies, and they've branched out into enterprise. Right. So this is the type of demand I want to see. I want to see companies that has products and services that are so widely used across so many industries and customer types that the TAM is huge. The total addressable market is super huge. And then there's also a currently large customer base, and then that is also growing, right? Outlook for Singapore REITs. So Singapore REITs have been dropping because of the recent interest rate news and such, right? A lot of investors are pretty panicky when you look at Singapore REITs over the past month, 2 months. There's a sudden spike down, and a lot of people are wondering, is it gonna crash? Here's my outlook on S REITs, right? So recovery, hospitality, retail, and commercial. These three sectors are their recovery sectors, which means they are going to go up eventually, but we don't know when. And we have to expect some short-term volatility. It's not gonna go up all the way one straight line. It's definitely gonna have some pullbacks. And it's very sensitive to news, right? We have safe havens, industrials and healthcare. So safe havens are really not affected by the pandemic. And as you can see, if you look through Ascendas REIT, Mapletree Industrial REIT, if you look through their FY 2020 results, right, you'll see that they're actually still increasing. Like the performance is actually still increasing despite COVID, which really proves how stable it is. Oops. And then also healthcare. Healthcare is also very stable. Healthcare REITs like Parkway Life, right? First REIT is not as preferred as for myself personally. I like Parkway Life more. And I've explained it tons of times to members of my premium subscription. I've also explained it through the articles that I've read on my website. So growth or value. So I personally like both. Uh if there's opportunities to make money, I'm gonna go to the place with the opportunity, right? Be it growth or value. Growth companies, for those who don't know, are these companies, right? Tesla, Palantir, Snowflake, Square, Lemonade. High growth companies, still making losses, but they're growing exponentially. These are what we call value companies, mature companies making consistent profits, growing profits, about low mid single digits every year, consistent, predictable, and we know and love these brands, right? Growth or value, there's no right answer, right? Just cause you go for growth doesn't mean you're gonna make a lot of money, and just cause you go for value doesn't mean you're not gonna make money. So it's really subjective and comes down to what are you comfortable with as an investor. Next point would be stock picks for the current correction. All right. As I've stated, I have a premium subscription, so I can't really share a lot of stuff. For the benefit of them. So if you would like to know the full list, you can definitely join. Uh, but I will share some of the things to look out for. Uh, during this correction that you could probably accumulate on. EV and clean energy, this is a huge trend, electric vehicles and clean energy. So even locally through the Singapore government recently during our budget, it's been said that we're gonna start phasing out petrol vehicles, right? We're gonna start phasing in electric vehicles and clean energy. So that's a huge industry to look out for. A lot of countries, not just Singapore, are moving towards that step. Second will be recovery industries, right? Retail, hospitality, um, industries that were badly affected during COVID would still be pretty attractive even right now because there's still signs of uncertainty in the market. So there's definitely tons of opportunity to accumulate. There are tons of other picks that I've shared specific companies, but I can't share it out here. But you could definitely join and find out. Question 13: how should I diversify my portfolio? So portfolio diversification is very important, as most investors know that have went through market crashes. So there's tons of ways to diversify your portfolio, right? So there's the very common one would be own your age in bonds, which is let's say if you're 30 years old this year, you're gonna have 30% of your portfolio in bonds. If you're 40%, if you're 40 years old, you have 40%, etc. So this helps because as you grow older, you're looking for more stability, and you're looking for stable and predictable income. So this strategy works well to a certain extent, but of course it limits the amount of growth potential your portfolio has because you have a portion of it in bonds, which are fixed income assets. You can also diversify across industries, which is something I personally do. So I'll invest in companies that are cyclical, non-cyclical, tech, REITs, etc. So if you diversify across multiple industries that will do well even during a crash and do well out of a crash in recovery, your overall portfolio might look very bad during a actual crash, but moving out of a crash is gonna do fantastic. And even during a crash, it might even stay afloat in the green as compared to the whole market which went red. And the last one will be invest in ETFs and robo advisors. This is the most basic strategy, which is your entire portfolio should allocate a certain portion into ETFs and robo advisors, so it allows you to diversify across the entire market. So thoughts on crypto and Bitcoin in general. So my thoughts are my biggest concern is that a lot of investors don't understand cryptocurrency. They just think it's a game you buy and then you're gonna make $1 million overnight and then gonna sell and you're gonna buy your Ferrari, you're gonna buy a private condo. That's a big problem, and there's a lot of FOMO going on in the market as well. So that's a huge problem with cryptocurrency. I personally um like the idea of cryptocurrency, right? And I believe that in the future, 20 to 30 years down, cryptocurrency might be a more popular thing. So companies like Tesla, as you might have seen in the news, are going to start accepting crypto and, if I'm not wrong, Bitcoin in specific as a payment option. So slowly but surely it's gonna phase in. But currently investing in crypto, there are definitely some concerns. Like I said, FOMO. The other would be it's not an income generating asset class, right? So it's the same as gold. Let's say if you buy a ton of gold, like 1 ton of gold today, and then you leave it in your storeroom, and then you wait next year, you come back, you're gonna look at it, it's gonna be the same 1 ton of gold with dust. That's the same thing with Bitcoin. You're gonna buy 1 Bitcoin today, you come back the next year, and look back in your wallet, it's gonna be 1 Bitcoin. It's not generating any cash flow, it's not generating any income, it's just a asset on its own. As compared to, let's say, if you invest in a business or invest in a farm, you know, let's say if you invest in a lemonade stand today, next year it makes good profits, they expand. You're gonna see 2 lemonade stands, you're gonna see 4 lemonade stands. There's a growth, there's an income portion of it that you can actually see and feel. And with non-income producing assets like uh commodities and cryptocurrency, it's a small risk. But of course, if you believe in the value that it has, of course you should go and invest. I personally do not recommend investors to get into crypto unless you understand it. That being said, I do have a small crypto position, and it's just a small little hedge for me to get in on if crypto keeps on booming. But it's not a very big percentage in my portfolio because I still stand by my belief, similar with Warren Buffett, that uh, one should not really invest in non-income generating assets because you can't really see the growth and you can't really see the value, right? So a very interesting question I got was thoughts on pawnbrokers. So MaxiCash and ValueMax. So these are popular pawnbrokers you see in Singapore. So what are my thoughts on it? So back in COVID, when gold was rising super fast, I was looking into pawnbroker stocks, right, at these companies, and you're gonna notice right away that with commodity prices going up, these companies are gonna make a lot of money because the entire business model has so much relation with commodity pricing. Basically, you're gonna sell to them, let's say, a gram of gold at $50, but if you're gonna buy it back, they're gonna sell it to you at $70 or $80 a gram. So they're earning a huge margin from that. And on top of that, the assets that they don't sell will actually grow in value, right? Because let's say you pawn off your gold pendant and they hold it, it's gonna keep increasing its value on its own because gold prices keep going up. So back in that time, I was looking at pawnbrokers. Definitely, I remember I made a buy call on one of them. I believe it's MaxiCash, but I can't be sure. But yeah, definitely pawnbrokers are interesting picks. I wouldn't really recommend putting a lot of money into them because commodity prices, like the hype of commodity prices, have definitely died down a lot. It's not gonna go up as fast as previously, and of course, because gold is inversely related to oil, and that oil is being pushed up this year by a lot of factors. I don't think pawnbrokers will do as well as last year. They're gonna do fine, right? And the dividend is definitely very attractive, but it comes down to what you're looking for when investing. Last question that I have was very specific: views on Manulife US REIT. So what better way to talk about it than let's actually dive into the financial statements. This will be a quick run through of how I actually look through a you know financial statements of a REIT. So this is their recent one that just ended. So let's take a look. So distributable income went up, fantastic. DPU fell 5.4%. Let's go and find out why afterwards. Strong collection, gearing's pretty high. I've talked about gearing quite a lot in the articles that I've written on my website, and I don't like companies with gearing more than 38% or 35% because it really limits on growth, and the company can't really grow meaningfully without kicking in equity fundraising, and that could really be dilutive for shareholders depending on the situation. The occupancy rate is decent. It's above the peers, so I'm satisfied with that. Leases are fine. Low subleasing, long WALE, so stability, right, in the portfolio. Moving on, let's dive into it. So I'm not gonna look into the half. I'm just gonna look in the full year. As we can see, revenue went up, NPI went up, dividend distributable income went up, but DPU fell. So the great thing about Singapore REITs and the way they present their results is that they put it in spreadsheet, right? They put it in a presentation slide as compared to reading through the financial statements. It's so boring, it's so dull. And with the presentation, it helps you save so much time when analyzing a REIT. So you can see higher MPI and distributable income mainly from the contributions of their new acquisitions, and then lower DPU because of lower income and provision for expected credit losses. So there's an explanation there. So of course I'm not happy to see drop in DPU despite everything going up, right? So that's pretty disappointing. But okay, I'll give it to them because we're not in a very stable environment right now. So making provisions is fine. NPI growth, so they're gonna showcase their portfolio, and it's great to see that some of them have managed to. So their newer acquisitions increased, some maintained, Mostly dropped here and there, but it sort of outweighed, which is fine. Strong balance sheet, so just tells you how much DPU and NAV afterwards. Fine. Debt maturity, 41%, as I've said, not really happy about that. Weighted average interest rate is 3.18%, so that's relatively high as compared to other commercial REITs and its peers. I don't remember the other REITs, but 3.18% is relatively high. I could be wrong on this, but yep. So weighted average interest rate, the number is, you're supposed to compare it to its peers, right? So let's say other US REITs like Prime REIT, Keppel, and then you can also compare it to the local ones that we have called Keppel REIT, Mapletree Commercial Trust, etc. So it's good that you compare it with the peers and then you see where it stands. And then weighted average debt maturity 2.3 years, and then interest coverage ratio at 3.5. So this is not very satisfactory because you will want this ratio to be higher. But 3.5 is decent, right? And then you can look through how much debt is gonna expire or sort of mature throughout the next 5 years. Portfolio performance, this is what I'm really looking for. So they're gonna talk about, the amount of lease executed in the year, the whale, rental escalation. You're gonna want to see rental escalation. So you're getting a pay raise every year. Uh, Moving on, long whale. So 5.3 years is relatively long, in my opinion. I don't remember the peers that well, but having a long whale provides a lot of certainty and stability to the portfolio. So it's nice to see that there's a very well diversified tenant base, spread across quite a few uh, industries. Moving on, whale for the oh, I believe there was an issue. Let me jump and get it back on. All right. All right, so 5.6 year whale for top 10 tenants. And you can see the top 10 tenants make up 35.8% of its gross revenue income. So this is, you want it to be lower, right? You want a more diversified tenant base, but it's fine in my opinion. And then they'll tell you about valuation and cap rate. And the the management likes to talk a lot more about moving forward, what they're gonna do, what's the trend like, and how's the REIT gonna perform. So I personally like to look at the presentation more when investing in REITs in specific. The presentation slides look fantastic, and you get all the information you need there. So that's my outlook on Manulife US REIT. All right, so I think that covers it. I have no more questions. So there's still some time left. I'm gonna take on some questions from you guys right now from the comment section, so you all can start asking questions. Or is there any part that anyone wasn't clear of that was confusing? Views on Neo. So Neo is it's another EV company, right? And it's a China EV company. So with Neo, it's a fantastic company, right? And it's very in trend because EVs are a huge trend right now. But my thought is that I would rather go for Tesla because number one, I like the management a lot more. I love Elon Musk as a CEO. The autonomous driving is a huge edge that Tesla has over its other peers, and of course, uh, Tesla as a brand is growing very fast globally. They are already coming to Singapore. They went to China, went to India. Much faster growth, and of course, granted, the growth potential isn't as high as compared to Neo because of market cap. Neo's market cap is about 72 billion right now, whereas Tesla is six 670 billion. Yep. But I would personally prefer Tesla over Neo. All right, next question. Fastly is not seen as high growth. Fastly is still high growth, in my opinion, because of the products that it has, specifically the edge computing. But recent results showed that customer growth has slowed down. This could definitely be a one-time or one-off problem, but we'll have to see from the upcoming quarters whether Fastly can still maintain uh, customer growth. MIT versus KDC, which one is a better investment given limited funds, right? So I I would recommend KDC. Obviously, this is a little hard to compare, right? With KDC being a pure data center REIT as compared to MIT, which has 60% of its portfolio in data centers and business parks. Of course, it depends on the investor, right? So if you want higher growth or whatnot, but let's pull up TradingView and let's take a look at these two companies. And let's see based on the TA, right, how it's gonna look. So let's pull up KDC. All right. So this is KDC. So as we can see, KDC has fallen substantially over from recent highs. So this would be what I call a recent high, not all-time high, but just like what is the recent highest price that it's been on. It's fallen about 20% or so, right? So based on its current based on its current valuation, we're looking at a 3.4% yield, which is pretty attractive for industrial REITs and specifically Capital DC because of how stable it is. And of course, there's a lot of value. I would say this would be called value, whereby from current price all the way up to its nearest latest or recent highs, there's about 20% gain that can go, right? It's a huge, like, 20% ish gain that can go up. On top of that, Capital DC has been fantastic, growing its dividends every year. The distribution has been growing fantastic. And let's pull out a quick calculation here. 0.0917, which is the dividends they gave out for FY 2020. You're looking at about 3.6% yield, and that's pretty great. For MIT, I believe it's about 4.4%. So in terms of yield, MIT is definitely more attractive. And if you look at recent highs, which is about here, it's more than 20%. So there's a lot more room for MIT to grow, definitely. So based on these few factors, I would say MIT. I would definitely pick MIT over KDC. Uh, any more questions before we end off the session? Taking one or two more questions. looks like don't think any more questions, so we'll be ending off the session here. Thanks to everyone that attended and basically stayed on, and hopefully what I shared today has has let you learn something new, right? And you've definitely taken something away from this. Comment on the investment style of ARK. Alright, so taking on last question. Investment style of ARK. Kathy Wood is a fantastic fund manager. Let's just put it out. I believe her investing strategy is pretty unique and pretty contrarian at the point of time. Uh, Basically, she looks for disruptors, right, in the industry. And disruptors are a huge thing because if you look at it, let's say 50 years back, no one was looking at electric vehicles, and then now the phasing in has kicked in, right? Subsequently, with more recent companies, you can look at Lemonade injecting tech into insurance, which is a very old industry but has no tech whatsoever. So I like the investment strategy, and have been adapting it and using it and applying it for some of my investments because I feel that the long term outlook is fantastic if you're looking at disruptors because if they can disrupt the industry, they're going to be a huge player in the market and they're going to be a huge force to be reckoned with, right? Another example is Netflix, right? Everyone thought, Netflix is not going to make it. Everyone's just going to watch TV, and look what happened 10 years down the road. No one's watching uh, TV much. Everyone has a smart TV and they're watching Netflix every night. So disruptors are a huge thing that shouldn't be taken lightly. And if you manage to find one, you should definitely look into it. And if it's a fantastic investment, just go on ahead. All right. So thank you guys for joining this session. Hopefully, I'll have another one in the future if there is opportunity. Hopefully, this session has taught you guys a lot of stuff. And if you are interested on more analyses that I've written, you can go to my website. It's in the description as alongside my premium subscription, which you can join as well. And then lastly, if you would like to sign up with a broker, I personally use and recommend Tiger Brokers. I've written tons of articles on my website as well, talking about the features and the overall platform. And you can use my referral to get tons of freebies like stock vouchers and free commission trades. All right, so thank you. Have a good night. The US market is going to open soon, so watch out for that.